Global markets have faced another eventful year. From shifting monetary policies to diverging regional growth trends, investors are reassessing what diversification really means in today's environment.
I think it's an incredibly exciting time to be an investor globally.
What we've seen since April is, I think, quite a striking return of risk appetite.
There are opportunities in the US, in Europe, and Asia to put money to work.
Today, we're taking a closer look at how Asia is responding to these market dynamics and what role it is playing in shaping the global investment landscape. Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Joining me from Singapore are Alex Brazier, Global Head of Investment and Portfolio Solutions, and Navin Saigal, Head of Global Fixed Income for Asia Pacific. Alex will share his latest insights from investors around the world, highlighting how global themes are both converging and diverging across regions. And Navin will take us inside Asia's fixed income markets, where he's seeing opportunities, where investors are turning cautious, and how Asia Pacific strategies are evolving compared to the rest of the world. Alex and Navin, thank you both for joining us on The Bid.
Thanks, Oscar. Great to be here.
Pleasure.
So Alex, you're currently joining us from Singapore, where you're going to be meeting with local investors and portfolio managers this week. Last time we spoke to you on The Bid, you were in London, and we were talking about the 90-day tariff pause and the implication for markets. That feels like a long time ago, and there's, of course, been a lot that's transpired since then. I'm wondering if you can give us an overview of what you've been hearing and what are investors thinking about across different regions?
Great. A nice straightforward question to start with. It feels like that was an eternity ago. But what we've seen since that point, back in April, is, I think, quite a striking return of risk appetite. Partly that was about the de-escalation of the tariff tensions. The other is the realization that AI and the tech sector, and the theme of AI, is really generating pretty strong earnings in the United States, and that's helped to propel US stocks upwards. And the third is that investors were persuaded that there was going to be a lot of both fiscal support and monetary policy support, a rare double combination in the United States. So that all underpinned a real return of risk appetite. But now, sort of taking stock, when we survey investors across the world, three things stand out. The first of those is there's really still appetite, even after all of that, to put cash to work. And actually, that appetite for risk assets, for equities, in our surveys, it gets strongest the further you go away from the US. So it's stronger in Europe than it is in the US, and it's even stronger here in the Asia Pacific region than it is in Europe. So that's the first thing, still putting money to work. I think the second thing is increasing thinking about how to diversify portfolios. People are always looking for diversification in portfolios, but they're going much broader now in their intentions than a kind of classic 60-40 broad equity, broad fixed income portfolio. A couple of highlights here. In our surveys, gold is the number 2 in terms of favorite future allocation in the Asia Pacific region. Unexpectedly, private market still there in all regions. And that's very notable, I think. And then thirdly, a new one here, which is liquid alternatives. They're a top 3 proposed allocation everywhere, all regions. These are strategies that look to generate return not based on the direction of the broad market, but on how things in the market perform relative to other things in the market. We can dig into that later. So that's diversification. I think the third thing that's interesting is we've seen more Fed rate cuts. And normally that's an environment where investors like to lock in income and they look to long duration treasuries. That really hasn't happened on this occasion. So here in the Asia Pacific region, investors have been putting money much more into short-term US bonds than into long-term US bonds. And they've been looking much more to fixed income, to bonds outside the US, including here in APAC. Partly that's because of the fiscal backdrop in the United States that's making long-term US bonds more volatile, but really notable interest in fixed income, particularly here in APAC, but generally outside the United States. But that really is Navin's wheelhouse.
And Alex, it sounds like from listening to you, markets really have been resilient. But you've also highlighted that investors are thinking about diversification into new asset classes. And so, Navin, one of the things that Alex mentioned is an interest in fixed income in the Asia Pacific markets. This is an area that investors are looking to get exposure to. So tell us a little bit more about the opportunities in the region that you're seeing.
It's a great question, Oscar. I think it's an incredibly exciting time to be an investor globally. There are opportunities in the US, in Europe, and Asia to put money to work. The real interesting thing about Asia today is that in the past, we used to see policy respond to changes in the fundamentals. But today, and for some time now, we have seen fundamentals respond to changes in policy. And therein lies the opportunity. It does create uncertainty and it makes an investor uncomfortable. An investor who's been focused on watching the fundamentals, it can be an uncomfortable time. But it does create opportunity because when policies diverge, you start to see divergences in asset prices that you did not expect or didn't used to happen. And we're seeing exactly that in Asia today. The policy divergence between the US and Asia has been extremely stark this year, and that has led to economic desynchronization. It's led to divergence in growth, in inflation, and in the bond market. And that's the critical part that ties back to Alex's point on diversification. When you get bond markets moving in different directions, prices moving in different directions, asset allocators love those types of assets because it helps create a less volatile, more resilient portfolio. That's what we're seeing in Asia today. You've got a loose fiscal policy in the US, much more conservative fiscal policy in Asia. You've got tariff policies that have diverged on either side of the Pacific Ocean, and that has driven a wedge between the economies on either side, creating desynchronization, divergence in bond markets, and an opportunity for investors to own Asian assets and benefit from the rally that we've seen in Asia this year. And boy, has it been a rally. Asian bonds have outperformed almost every developed market bond. That has been a huge benefit to our portfolios here.
Navin, you said two words that jumped out as you were going through your views, and you mentioned economic desynchronization. It's a bit of a mouthful, but I think what it essentially means is that you have different asset classes in different parts of the world behaving very differently due to differences in policy and fundamentals, and that sort of opens up an opportunity for diversification. And so, Alex, to come back to you, and maybe to switch to equities, what are you hearing from investors about the opportunities in equities as you talk to investors across different regions?
Yeah, I think a similar thing on the equity side. It links to what Navin was saying on fixed income, which is people looking for diversification, for things that aren't closely correlated. And that's actually first showed up in February to May with pretty sharp inflows from investors into exposures to Europe. So after a long period of very little interest in Europe, effectively after the Munich Security Conference, Germany announces a fiscal policy loosening, more defense spending, more infrastructure spending. And that helped for investors who were underallocated to Europe. It helped to drive some of those flows into Europe. But that wasn't really at the expense of the US. We've still seen steady inflows into the US, especially from investors here in APAC. But now we're seeing something potentially quite interesting when we survey clients. The first is that they're looking for that geographic diversity that Navin was describing in the fixed income world. They're looking for that in the equity world as well. So they're looking for exposures sometimes outside of the United States, including here in the Asia Pacific region, and across emerging markets as well. And in some ways, that reflects the fact that the US markets become quite concentrated. So people often talk about AI bubbles. Actually, I don't think it's a bubble. I think it's a mirror. It's a reflection of what's actually going on with earnings in the US economy. There's a hell of a lot of earnings growth around the tech sector and the build out of AI, and the market's reflecting that. But still, investors looking at the resulting composition of the stock market and saying 40% of it's now in the top 10 stocks. So how do you diversify? And actually, people now looking pretty broad to diversify across the globe. In each region, the top ranking equity planned allocation is equity in that region, except for in the US, where they're looking to move and diversify from the US to developed markets outside the US. So that geographic diversity is a big thing. Final point here is that where investors are looking at the US, they're much more confident about earnings growth and companies in the United States than they are about the US dollar. And so we've seen, for example, big flows into hedged US equities. So investors telling us that they like US equities, but they're worried about a further depreciation of the US dollar. European investors, for example, in the first half of the year, would have seen very little return in their currency, the euro, on investments in US stocks because the market in the US went up, but the currency went down, sort of netted out. But also, even for other investors, the dollar has just not been behaving like it used to. In periods of volatility, the dollar used to be a source of strength in the portfolio. Now it's not provided that role. So people are looking for other diversifiers in the portfolio, but they're also not looking to the dollar as a source of stability in the portfolio, and they're looking to hedge more. So continued flows into the US, appetite for Europe eased off, looking though for geographic diversity now, and where investors are looking at the US, they're hedging the currency risk a bit more than they used to.
Alex, I'm glad you mentioned currency. I think we often talk about the stock market and the bond market, but currency can have a very big impact on investment returns depending on where you're sitting in the world. You have to think about that in your home country. And so, Navin, maybe coming back to you as a fixed income investor, how do you think about currency risk and hedging that in your portfolios?
Oscar, that's probably the single most asked question is how do we think about dollar exposure? And it's an incredibly interesting question. I also think the media have hyped this up way too much and used binary terms like de-dollarization, buy America, sell America, which I don't think fully appreciate the nuance of this debate. I think from an investment perspective, the dollar should be viewed exactly as one would view any other asset, specifically through the lens of risk and reward. Now let's break that down. Let's start with the risk. The single biggest change for the dollar for investors this year, I think, has been the change in correlation of the dollar to the standard 60-40 portfolio. That correlation had a long-standing negative slant, negative bias. The dollar effectively acted as a hedge to a portfolio of stocks and bonds. That has changed this year. That negative correlation has flipped to positive. In other words, one could argue the dollar has become a riskier asset. But let's move on to return or reward. Now, we must remember that the US yield curve sits a little higher than most other yield curves in the world. So adding dollars to the portfolio is actually accretive from a yield perspective. Now, I mentioned that global yields are attractive for a fixed income investor from the US to Europe to Asia. I mentioned that in the context of a US investor, you're able to source a 6% yield in dollars through a global diversified portfolio. Most of the time today, converting those dollars to other currencies, you'd have to give up yield, or in other words, pay to hedge back your currency to a local currency. That is worth something and should be talked about. Putting both together, I'd say that if last year the right slant was to be overweight dollars, to have more dollars because it was a hedge that paid you to own it, this year, I think a more neutral stance is probably warranted, given that the risk of the dollar relative to the portfolio has risen, but the reward, the return, is actually still pretty high.
You know, in listening to you, Navin, one of the things that I'm reminded of is, as we've talked to guests on the bid more recently, we've really seen examples of historical market relationships that used to be one way in the past, but now they look very different. And you're talking about the US dollar and how it used to be more of a hedge in a portfolio. And now it's become a riskier asset. Both of you have mentioned that there are interesting investment opportunities and a desire to diversify outside of the US. Navin, you're sitting in Singapore. That's where you're based. What are some of the challenges of investing in the Asia-Pacific region?
You know, Oscar, I spent 12 years as a portfolio manager in New York. I actually remember a meeting I did with you when I was an intern about 15 years ago with the Bank of Korea. And boy, have times changed since that meeting. But the biggest challenge since I've moved here to Singapore from New York is adapting to the size and liquidity of the markets in Asia. In New York, we'd get a risk budget or an allocation budget from our lead PM. In my case, that's Rick Reeder. And we'd have really no trouble from a liquidity or size perspective putting that money, that capital to work. It's a different matter in Asia. Putting capital to work is actually a challenge because of the size and liquidity of the markets here. There just aren't enough bonds. There aren't enough bonds in Asia for the amount of capital that would like to be invested in Asia. And that is the biggest challenge. I'll give you an example. In Singapore, the Singapore government bond market is about $200 billion. That's about the size of a US corporate segment. It's smaller than the single B market in the US. And it trades like that too. Trade sizes have to be adjusted downward. Positions have to be legged in slowly. That creates a challenge for large pools of capital to be reallocated across borders. However, I will note that if you looked at Asia or say non-US bond markets as a block in their entirety, then you do start to get to a size that does make sense from a capital allocation, from a diversification standpoint. It just requires a deeper and broader pool of resources, people on the ground, knowledge of the regulation jurisdictions in order to navigate the myriad countries and currencies involved.
Well, and I like how you have contextualized the size of the Singaporean government bond market. At first, when you hear $200 billion, that sounds really big. But then I think you mentioned it was the size of the single B corporate market. In other words, a certain segment of the U.S. corporate bond market. And that puts it into perspective that we're really dealing with different liquidity in different markets. Alex, we've talked about diversification in equities and in fixed income, as Navin has just highlighted. But I think you mentioned some other areas that investors are looking to diversify into. Maybe you could talk a little bit more about that.
Yeah, I mentioned some of them earlier, but just to sort of draw it together a bit. Across equities and fixed income, as both Navin and I said, people are looking to diversify geographically those exposures and seeing opportunities in different places. They're looking to tone down their exposure to the US dollar. As Navin says, it is quite nuanced. I would highlight just a couple of other things, though. The first is gold. Gold hits the number 2 rank in this region when we ask people, where are you planning to allocate? Gold's number 2 in the ranking after local equities. And I think partly that's because investors are attracted by what they see central banks doing, reallocating reserves. But I think it also relates to this point Navin was making just now, which is that the dollar has become correlated with the 60-40 portfolio in the opposite direction to the way it used to be. It used to be a stabilizer of your 60-40 portfolio. Now it's been a kind of amplifier of moves in that. Assets like gold have proved to be a better hedge for volatile equity episodes. But there's an interesting regional divergence there in that investors here, I said, it's their number 2 ranked asset. In the US, it's fallen a bit down the rankings. So interesting regional divergence there. One thing, though, that people do have in common across the regions, and I mentioned this earlier, is their appetite for liquid alternative strategies. So strategies where the return isn't based on what the broad market does, but where it's based on what one part of the market does relative to another part of the market. And I think there's a couple of things behind that. One is that after a big run up in stock prices, all-time high after all-time high, people thinking maybe there's not so much juice left in the lemon, and they want something that gives them more of their return from that relative performance than from the absolute. The other is, as Navin was hinting at earlier, stocks globally less well hedged by bonds globally now in an environment where many developed markets have stretched fiscal positions. That stock-bond correlation has become less reliable. So people looking to change their portfolios, take down their exposure to the broad market. And I think the third thing is, though, there's more opportunity to generate return from one asset versus another asset, more cross-sectional dispersion, as the investors like to say. And put those three things together, and it's a case for building a portfolio that's less sort of 60-40 broad market risk. It's more geographically diverse, and it's got more of these more market neutral exposures in it as well. And those themes, I think, pretty common across the globe.
Right. So you mentioned gold, which we've talked about recently with guests about how it has become an asset class that people are looking to as an alternative to the US dollar. And then you also talked about maybe investors who are worried about where the market is right now in terms of the cycle, given that we keep hitting new all-time highs, it seems like every week, and therefore looking to strategies that benefit from more relative value opportunities, I think is what you said, Alex. Maybe to both of you, as we wind down 2025, what are some of the things that you're looking to as the year wraps up?
I'm watching employment in the US and fiscal policy in Asia. I think that there's an incredibly interesting dynamic going on in the US where economic growth in the aggregate is still pretty resilient, but at the margin, the average employee, and certainly the bottom half of the income spectrum, is starting to struggle a bit to adapt to a few years of higher prices, and fairly high interest rates. Car loans, student loans, mortgage rates, those are pretty high. So it'll be interesting to see how the Fed navigates this situation. And we think they will probably err on the side of caution by cutting rates to help to ease the consumption employment problem, given that inflation has come fairly under control, at least compared to 2 to 3 years ago. That creates a very interesting environment for bond markets because you'll have a little bit of convergence. I mentioned divergence just now. This actually creates a period of convergence where you could see the Fed easing and Asian central banks easing as well because of the divergent inflation trajectories in both parts. In Asia, I think the biggest spanner to hit the works would potentially be a change in fiscal policy. If growth stays fairly subdued, inflation stays weak, deflation gets talked about, bandied about as a possibility for long term, then you could see governments start to ease fiscal policy. And that would start to impact a bullish view on Asian bond markets. But we don't see any signs of that yet. It's something we're just watching very closely for.
Difficult to top that. So I think first thing on my mind is people saying, I love my home region. I want more of my home region. It's whether that actually happens or whether it's a bit like that prayer that I think was attributed to St. Augustine. Lord, make me geographically diverse, just not yet. So I'm kind of interested to see if it actually happens. The second point, though, and it links to a point Navin made earlier, is really bears close watching how the dollar continues to behave in these moments of volatility and stress. Does it reestablish its role as something of stabilizer, or is it something that's going to behave very differently in the future to the way it behaved in the past? Because, as Navin was saying, if it is going to behave differently, that has real implications for how you think about currency hedging and about how you think about putting the broader portfolio together. So we're going to learn a lot in the next few months, I'm sure.
Well, it's been great hearing both of your perspectives on global markets, investor trends, the Asia-Pacific region. Alex, it's always great to have you on. I know you're a long ways from home in London, and we appreciate you battling through what I'm sure is some pretty serious jet lag. And Navin, I do remember that presentation 15 years ago. I hope I still look the same as I did back then. Great to see all the success that you're having in Singapore. Thank you both for sharing your perspectives, and thank you for doing it here on The Bid.
Thanks a lot, Oscar. Really a pleasure to be on the show.
Thanks, Oscar. Great to join you.
Thanks for listening to this episode of The Bid. Next week, Jim Cramer from CNBC's Squawk Box joins us to tell us about his new book, How to Make Money in Any Market. Make sure you're subscribed to The Bid and don't miss the episode.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.